world economy as sort of, or the world financial system as being this sort of whole load of carry trades that are partly correlated and related to each other, and people are hedging risk and transferring risk, as you just suggested. So you've got this great kind of system of carry trades across markets across the world. We're sort of saying the US is at the center of that kind of nexus. And the we'd argue, and it's a more complicated argument in the book, we argue the actually S&P 500 is very critical because a lot of risks are hedged back into the S&P 500 because it's the most liquid volatility trading market. But that means that the US is the source of funding. Like I mentioned, the idea of, say people in Turkey borrowing US dollars because it's so much cheaper to borrow than Turkish lira, and then using those US dollar borrowings to finance investments in Turkey, or hedge funds or asset managers around the world borrow US dollars. But it raises the interesting question to an economist, at least, how is that possible when the US has a trade deficit? Because it's a capital outflow. It's easier to understand. Before the global financial crisis, I spend a lot of time trying to analyze the yen-funded carry trade, which is people around the world borrowing yen. Because if you remember, yen interest rates were kind of zero for a long time before interest rates went to zero roughly everywhere else, because Japan had its big crash in the 1990s. So people were borrowing yen to fund kind of investments around the world. So I used to call it the yen carry trade. And other people focused on that too. But that was quite easy to understand because Japan had a big savings surplus, had a big current account surplus, big trade surplus. So there was like a surplus of yen, which for people to borrow from, if you like, if you look at it like that. But the US actually is a deficit economy. It has a current account deficit. So the US actually needs financing for that deficit from outside. So the question then, well, how can we say that all these carry trades around the world are being financed out of US dollars when the US itself needs financing for its deficit? And that's where this circular flow comes. And really what we're saying in the end, it is foreign reserve. It's the growth of, and you can see this from statistics, foreign reserve statistics around the world. The financing is really coming from the growth of dollar foreign reserves held by central banks and governments, sovereign wealth funds around the world. They've grown enormously. And I mean, I haven't checked the data recently, but the Chinese foreign reserves themselves are about $3.5 trillion or $3 to $3.5 trillion.